Hi, welcome back to the channel. In today's episode, I want to provide you with another update on the ongoing impact on the global economy of the war in Iran, because we are now starting to see the real economic damage feeding through. And the big point today is this. This is no longer just about missiles, oil tankers, shipping lanes, and geopolitical risk. This is now starting to show up in actual economic data. Business activity is falling, unemployment is rising, energy prices are still elevated, bond yields are surging, and Europe in particular looks like it's starting to crack first. So today we're going to have a look at what's going on with the oil price, natural gas prices, bond yields, the latest data from the Eurozone, the latest data from France, and what all of this means for the global economy. But before we get into all of those details, can I ask anyone that hasn't subscribed yet to please hit that red subscriber button? Really helps me with the algorithm and also puts a smile on my face. Okay, so let's start with the first graph, because this one explains much of what's going on. This is what's been happening to the oil price. At the start of 2026, Brent crude was trading at around $60 per barrel. Today, it's above $100 per barrel, and that is a huge move in a short space of time, because oil is not just something that affects the price of you filling up your car. Oil feeds into transport, it feeds into shipping, aviation, food, manufacturing, plastics, chemicals, fertilizer, packaging, distribution, and almost everything that moves around the global economy. So when oil goes from $60 to $100 in a short space of time, that is not just a chart moving higher, that is a cost shock. And the problem is that this cost shock is now lasting long enough for companies not to be able to absorb it anymore. At first, businesses can hold their prices, they can take a hit on their margin, they can delay decisions, they can hope that the situation calms down and prices go back to normal. But when the pressure keeps building and prices go up, orders start getting cancelled, investment gets delayed, consumers cut back, and companies start looking at costs, jobs, and ultimately survival. And that brings us to the second graph, which is European natural gas. At the start of this year, European natural gas prices were around €27 per megawatt hour. They are now sitting above €49. That is a huge increase. They've almost doubled. And this is particularly dangerous for Europe because natural gas is not just used for heating homes, it's used to generate electricity. A lot of the European countries moved away from coal-fired power stations to gas-fired because it was more environmentally friendly. And a lot of that gas originally was coming from Russia. It then increased the cost because they had to switch to LNG. But unfortunately, the price of LNG has now gone through the roof. And gas is also used by industry. It's also used in chemicals, fertilizers, glass, steel, food production, and all sorts of energy-intensive sectors. So if gas prices rise sharply, electricity prices rise, factory costs rise, the cost of producing goods rises, and once again inflation starts spreading through the system. This is why Europe is so exposed. The United States has energy, the Middle East has energy, Russia has energy, but Europe imports a lot of what it needs. So when global energy markets get disrupted, Europe gets hit very quickly. And I think that is exactly what we are seeing right now. The latest Eurozone data shows business activity has contracted at the fastest pace since 2023. The Eurozone composite PMI has fallen to 47.5. So that's the Purchasing Managers Index. If you follow the channel, you'll know that this is basically a survey taken of all of the purchasing managers, asking them whether or not they are expanding or contracting their purchasing. And a score below 50 represents contraction. So 47.5 is a contraction. So this is not just slower growth, this is the private sector shrinking. New orders are falling, services are weakening, companies are cutting jobs, confidence is dropping, and inflation pressures are rising again. That is the nightmare combination. Weak growth and rising prices. In other words, stagflation. And France looks like it's being hit hardest. French business activity has slumped at the fastest pace since 2020. Let's not forget 2020 was the COVID pandemic. The French composite PMI has fallen to 43.5. Now that is a long way below 50, so that is a very weak number. The services sector has been hit particularly hard, and manufacturing has also turned down. So France, the second biggest economy in the Eurozone, is now flashing a serious warning sign. And we've also had French unemployment figures which have risen above 8% for the first time in many years. That matters because once unemployment starts rising, the economic problem changes. It's no longer just an inflation problem, it becomes a consumer problem because people spend less, confidence falls, businesses get more cautious, governments collect less tax, welfare costs rise, and the pressure on public finances gets worse. And that brings us to the bond markets. The US 30-year bond yield has hit its highest level since 2007. That's just before the global financial crisis, which started kicking in 2008. That is a major warning sign because bond yields are basically the cost of borrowing. And the US 10-year yield has moved from around 4.1% at the start of this year to the current level of 4.6%. Now that might not sound like a huge move, but when governments are carrying record levels of debt, it matters enormously. Higher bond yields mean higher borrowing costs for governments, for companies, for mortgages, for credit cards, for business loans, for everything basically. And this is the trap. The war pushes up energy prices push up inflation, inflation keeps interest rates higher, higher interest rates damage growth, and weaker growth makes it harder for governments and companies to manage their debts. So central banks are now stuck. If they cut interest rates to support the economy, they risk making inflation worse. But if they raise interest rates to fight inflation, they risk pushing already fragile economies into recession. And that's why the latest comments from the European Central Bank matter. We now have warnings that a rate hike in June becomes quite likely if the war in Iran does not end. Now think about that for a second. Europe is already weakening, business activity is contracting, France is struggling, unemployment is rising, energy costs are high, and the ECB, the European Central Bank, may still have to raise interest rates because inflation is being driven back up by the war. That is a horrible position to be in. And then, layered on top of all of this, we still have the Strait of Hormuz problem. There are reports that Iran is tightening control over the strait with inspections, checkpoints, political deals, and in some cases payments for fees for safe passage. Some countries appear willing to pay because they just want their tankers to get through. But that creates a very dangerous new reality. Because if one of the world's most important energy routes effectively becomes a controlled toll road during a war, then global energy security has changed. And even if ships can still pass, the cost, uncertainty and risk all rises. Insurance costs go up, shipping costs go up, delivery times become less predictable, and the price of energy stays elevated. So the market may get excited every time there's a rumour of peace talks. We may see oil drop for a day or two, we may see stocks bounce, but unless the underlying problem is resolved, the damage continues. And that's the real issue here. There is still no clear solution. Donald Trump has repeated threats to strike Iran again if there is no deal. Iran is still trying to exert control over the strait. Energy prices remain elevated. Europe is now weakening. Bond markets are under pressure, and the economic data is starting to show the impact. So the big question is this: are we still looking at a temporary shock, or are we now moving into something more permanent? Because if oil and gas prices stay high for months, and if shipping through the Strait of Hormuz remains uncertain, then this is not just a short-term market panic. This becomes a structural increase in the cost of doing business, a structural increase in the cost of energy, a structural increase in inflation, and potentially a structural hit to global growth. And that is why I think Europe is the first place to watch. Europe is heavily exposed to energy prices, it's heavily exposed to global trade, it already had weak growth before this crisis started, and now the data is starting to deteriorate very quickly. The danger is that France is not the exception. France may simply be the first major economy where the damage is becoming obvious. So this is a very important moment. Markets are beginning to acknowledge the problem, bond yields are moving, energy prices are still high, economic data is weakening, and central banks may be forced to tighten policy at exactly the wrong time. That's why today's update is so important. The war in Iran is no longer just a crisis between 2 or 3 countries. It's now becoming a global economic crisis. And the longer it continues, the greater the risk that this damage spreads from energy markets into inflation, into interest rates, into employment, into company profits, and eventually into the whole global economy. So I'll keep you posted on any further news and developments. But hopefully you found today's video useful, informative, and most importantly, thought-provoking. If you've liked what I've said, or maybe you didn't like it but you thought it was interesting, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already.